On a Tuesday afternoon, a 42-year-old software project manager opens the payroll portal and does the thing every financial article has told her to do. She drags the 401k contribution slider up to the annual maximum, $23,500 for 2025, and enables auto-escalation so it climbs again next year without her having to think about it. She closes the laptop feeling the specific, quiet satisfaction of a person who is finally getting it right. 2 weeks later, the direct deposit lands, and it is smaller than she expected. Not catastrophically, just enough to notice. Enough to make her open the pay stub and actually read it for the first time in months. That pay stub is where the story starts. Because on paper, she is the model citizen of the American retirement system. She earns roughly $145,000. She maxes the 401k. She carries almost no debt. She has an emergency fund, a low-cost index portfolio, and a spreadsheet she updates on the first of every month. She has done, in order, nearly everything the culture defines as financially responsible. And she has a nagging, unglamorous feeling she cannot quite justify, that for all the discipline, the tax bite feels heavier than it should. Heavier, somehow, than it seems to fall on people with far more than she has. Here is the observation worth sitting with. The instinct in personal finance is to treat that feeling as a character flaw, envy, or poor planning, or simply not reading enough. The assumption is that if a saver feels overtaxed relative to the wealthy, the saver must be missing something obvious. Do more research. Find the loophole everyone else found. But that framing gets the mechanism backwards. The uncomfortable possibility this video will examine is that the feeling is not paranoia and not ignorance. It may be arithmetic. It may be that the specific behaviors that make someone a disciplined W-2 saver, earning through labor, deferring into pre-tax accounts, following the visible rules, are precisely the behaviors that route her money through the most heavily taxed channels the code contains. Not because she did it wrong, because she did it exactly as instructed. That distinction matters, and it will matter for the next 40 minutes. There is a difference between paying more tax because you earn more, which is how a progressive system is supposed to work, and paying a higher share of each real dollar of economic gain than a household sitting on 10 times your net worth. The first is fairness. The second is a structural feature almost nobody explains, because explaining it requires separating two numbers that most people, including plenty of professionals, quietly treat as the same thing. The wealthy household in this comparison is not smarter than the saver. In many cases, it is not even more disciplined. What it has is access to levers she never touches. Levers embedded in the design of the code itself, most of them perfectly legal, several of them nearly automatic once you know they exist. The question is not whether the saver is doing enough, she is doing more than enough. The question is stranger and more unsettling. If she did everything right, why does the tax code appear to treat her worse than someone who did almost nothing but hold? The answer begins with a single number, the one that separates the feeling from the fact and turns a suspicion into arithmetic. 24%. That is the marginal tax bracket the software project manager sees when she looks up where her $145,000 salary lands in the 2025 federal schedule. It is the number she quotes at dinner when someone complains about taxes. It is the number that shapes how she feels about every raise. And it is, in almost every way that matters, the wrong number to be carrying around in her head. Because a marginal bracket describes exactly one thing: the tax on the next dollar she earns. It says nothing about the dollars underneath it. The federal system stacks brackets like floors in a building. The first slice of taxable income is taxed at 10%, the next at 12%, then 22%, then 24%. Her top dollar sits on the 24% floor, but most of her income is taxed on the floors below it, at lower rates. That is what a progressive schedule does, and it is the source of the first great confusion in American tax life. So here is what the 24% hides. Run her actual federal calculation. Take the $145,000, subtract the maxed 401k contribution of $23,500 and the 2025 standard deduction of $15,000, and taxable income lands near $106,500. Apply the stacked brackets, and the federal income tax comes to roughly $18,000. Against her gross salary, that is an effective federal income tax rate of about 12%, not 24%. The bracket overstated her burden by half. If the story ended there, this would be a reassuring video about how taxes are gentler than they feel. It does not end there. Because the effective rate that actually governs her life is not the federal income line alone. Layer in the payroll taxes carved out of every paycheck, 6.2% for Social Security up to the wage base, 1.45% for Medicare with no ceiling. Those are not marginal. They hit from the first dollar, at full rate, with no bracket structure softening the bottom. Add her state income tax. Call it a mid-single-digit rate in a typical state. Now recompute the blended effective rate on her labor income, and the number climbs back up into the low to mid-20s. That is the recalculation that matters. The bracket said 24%. The naive effective rate said 12%. The honest, all-in effective rate on her real economic gain, the share of each dollar she earned that she never gets to keep or invest, sits somewhere close to where the bracket started, but assembled from entirely different parts than she assumed. And this is where the comparison the whole video turns on becomes possible. You cannot compare a saver to a wealthy household by comparing brackets, because they may sit in the same bracket and pay wildly different shares. You cannot compare them by federal income tax alone, because that ignores the payroll layer that falls hardest on labor. The only honest instrument is the blended effective rate on real economic gain, every tax paid, divided by every real dollar earned. That is the ruler this documentary will use for the rest of its running time, and it is the ruler almost nobody uses in casual conversation about who pays their fair share. Hold on to that assembled number, because it exposes something the saver has never had reason to notice. Every component of her tax bill, the stacked income brackets, the flat payroll levy, the state layer, attaches to the same underlying thing. It attaches to labor, to income earned by showing up, applying skill, and being paid for time. Her salary, her bonus, the future withdrawals from that pre-tax 401k she just maxed. All of it is, or will become, ordinary income taxed as labor. And that single shared trait, the one running through every dollar she brings in, is the exact trait the wealthy household's dollars are engineered to avoid. Labor income is the only category of income the federal government taxes before it ever reaches the person who earned it. That is the mechanism, and it is worth stating flatly because it sounds too simple to matter and it changes everything. When the software project manager's employer runs payroll, the tax is withheld at the source, computed, subtracted, and remitted to the Treasury before a single dollar lands in her account. She never holds the money. She never gets to decide when it counts. The Social Security tax, the Medicare tax, the federal and state income withholding, all of it is calculated on a schedule she does not set, in a year she cannot choose, at rates that apply the moment the pay period closes. Her income is taxed at the source and in real time. Now hold that against how a dollar of investment gain behaves. Consider a share of stock bought at $40 that is now worth $140. That $100 of appreciation is real. It has happened. The holder is $100 richer in every economic sense that matters. And the tax on it is exactly zero. Not deferred, not reduced, but zero, until the moment the holder chooses to sell. The gain sits there, compounding, entirely untaxed, for as long as the owner decides to do nothing. The IRS does not tax appreciation. It taxes realization. And realization is a decision, not an event that happens to you on payday. That is the contrast in its purest form. The saver's gain is taxed the instant it is earned, whether she wants it recognized or not. The holder's gain is taxed only when and if he decides to recognize it. One party is a taxpayer by default, the other is a taxpayer by election. Deepen it and the disadvantage compounds. Timing control is not a minor convenience. It is the most valuable feature in the entire code. The holder can choose to realize a gain in a low-income year, or in retirement, or in a year he has losses to offset it against. He can spread realizations across decades. He can, in some cases, simply never sell and let a different mechanism erase the tax entirely, a mechanism this video will name later. The saver has none of these options for her salary. Her labor income is recognized in the year it is earned because there is no other year available to it. Time for her wages is not a lever, it is a fixed point. And the rate the two forms of income pay once recognized is not the same rate. Long-term capital gains and qualified dividends are taxed on a separate, gentler schedule: 0%, 15%, or 20% at the federal level, topping out below where ordinary income tops out, and entirely untouched by payroll tax. The saver's wages face the ordinary brackets plus the full 7.65% payroll layer on top. The holder's realized gains face a lower ceiling and no payroll levy at all. Same dollar of economic gain. Two completely different toll roads. So the mechanism has three moving parts, and labor loses on all three. It is taxed at the source, before the earner can plan around it. It is taxed on the system's timing, not the earner's. And it is taxed under the ordinary schedule with the payroll surcharge attached, not the preferential one. Character, timing, collection point. Every structural advantage the code offers sits on the capital side of the ledger, and the saver's paycheck touches none of it. This is what a disciplined saver quietly does that costs her. She earns almost everything through the one channel engineered to be taxed first, taxed fastest, and taxed hardest. Not through any error. Through the ordinary, admirable act of trading her labor for money and being paid on schedule. Which is why her single proudest financial move, the maxed pre-tax 401k, the slider she dragged to the top, does not escape that channel at all. It defers it, and deferral, it turns out, is not the same thing as avoidance. It simply locks in tomorrow's ordinary rates on a day she cannot yet see. The whole case for the pre-tax 401k rests on a single, seductive assumption. It is worth stating in its strongest form before taking it apart, because millions of disciplined savers have organized their entire financial lives around it, and they did not do so foolishly. The assumption goes like this: contribute pre-tax today, and you skip the 24% bracket on that dollar right now. You invest the full amount, untaxed, and let it compound for 30 years. Then you retire, your income drops, and you withdraw those dollars in a lower bracket than the one you avoided. You arbitraged the rate. You paid the tax on your own terms, later and cheaper. Defer high, withdraw low. On its face, that is not a myth. For some savers, it is exactly true, and for them, the 401k is close to unbeatable. So steelman it fully. The dollar she deferred at 24% genuinely was not taxed at 24% this year. It compounds on its full pre-tax balance. If she retires and pulls modest withdrawals that land in the 12% bracket, she wins the arbitrage cleanly, and every article that told her to max the account was right. Now the rebuttal, and it arrives through a counterexample rather than a formula. Consider a diligent saver who did the thing correctly for 35 years. She maxed the account annually. She earned raises. Her balance, compounding through decades of contributions and market growth, reaches roughly $2.4 million by 67, an entirely ordinary outcome for someone who started early and never stopped. Nobody would call that a mistake. But here is what deferral did to her. Every dollar in that account is pre-tax. None of it has ever been taxed, which means all of it will be as ordinary income on the labor schedule at whatever rates exist decades from now. And the code requires her to start emptying it. Required minimum distributions under the Secure 2.0 rules begin at 73. On a balance that size, the first-year RMD alone is well over $90,000, computed by dividing the balance by an IRS life expectancy factor of roughly 26.5. She does not get to choose that number. The account she built for freedom now hands her a mandatory paycheck she cannot decline. Add her Social Security benefit on top, and her taxable income in retirement is not lower than her working years. It is comparable, sometimes higher. The arbitrage she was promised, defer high and withdraw low, quietly inverts. She deferred at 24% and is now withdrawing into the 24% bracket, or worse, because the balance grew large enough to refill the very bracket she thought she had escaped. This is the answer to why deferring tax sometimes costs more than paying it now. Deferral does not delete the tax. It converts a known rate today into an unknown rate on a much larger balance decades away, and it strips away her single most valuable option along the way. Money in a taxable brokerage account can be realized in a low year, offset against losses, or held indefinitely and handed to heirs. Money in a pre-tax 401k can do none of that. It comes out as ordinary income, on the system's timing through RMDs, taxed as labor to the very end. She traded flexibility for an upfront deduction, and the deduction was the smaller prize. None of this makes the account worthless. The match is free money. The deferral still helps savers whose retirement income truly collapses. The point is narrower and sharper. The saver's proudest move did not move her dollars out of the high tax channel. It scheduled them to arrive there later, compounded and mandatory. And the arithmetic gets worse in a way she has no reason to anticipate, because those forced withdrawals do not just get taxed themselves. In retirement, a second mechanism climbs on top of the first, one that reaches over and taxes a benefit she already believed was largely hers. Here is a number that stops most retirees cold when they first meet it. For every additional dollar a middle-income retiree pulls from that 401k, up to 85 cents of a Social Security dollar can be dragged into taxable income alongside it. Not the retiree's dollar. The government's benefit, the one she paid into for 40 years, reclassified as taxable because of a withdrawal she was forced to take. This is the mechanism the planning world calls the tax torpedo, and the name is precise. It does not announce itself. It sits below the surface of the tax return, in a formula almost no one reads, and it detonates exactly in the income range where disciplined savers land. Follow the tension of it. Social Security benefits are not automatically taxable. Whether they get taxed and how much depends on a figure the code calls combined income, adjusted gross income, plus tax-exempt interest, plus half of the annual benefit. As that combined figure crosses two thresholds, $25,000 and $34,000 for a single filer, $32,000 and $44,000 for a couple, a rising share of the benefit gets pulled into taxable income, up to 50% above the first threshold, up to 85% above the second. Those thresholds were written into law in 1983 and 1993. They have never been indexed to inflation. 40 years of wage growth have quietly walked nearly every diligent saver straight into them. Now the discomfort. When the saver takes her required distribution, the $90,000 she could not decline, that withdrawal does not just get taxed on its own. It inflates her combined income, which drags more of her Social Security benefit across the thresholds, which adds that benefit to her taxable pile too. $1 of withdrawal can trigger tax on itself and on up to 85 cents of benefit simultaneously. The result is a marginal rate on that withdrawal that is not her 22% or 24% bracket at all. Studies of the effect put the true marginal rate through the torpedo zone at anywhere from 40% to over 50%. On income, the bracket table claims is taxed at 22%. The Social Security Administration and independent researchers have documented this directly. A widely cited analysis in the Journal of Financial Planning traced how the torpedo produces marginal rates 1.5 to 1.85 times the stated bracket for retirees in the affected band. Precisely the band that a lifetime of maxed pre-tax contributions delivers people into. The retiree who did everything right built a balance large enough to guarantee the withdrawal that triggers the surcharge on the benefit she earned. And now the relief, because there is some. The torpedo is not a permanent condition, it is a range. Above a certain income, once 85% of the benefit is already taxed, there is nothing left to pull in, and the inflated marginal rate collapses back to the ordinary schedule. Very wealthy retirees sail past the torpedo entirely. Their benefit is fully taxed no matter what, so no single withdrawal makes it worse. The torpedo is aimed with almost cruel precision at the middle. Too much income to escape it, not enough to have already cleared it. Which is the revelation this block was built to deliver. The tax torpedo is not a penalty on wealth. It is a penalty on a specific, common, disciplined outcome. A pre-tax balance large enough to force withdrawals, paired with a Social Security benefit large enough to be dragged. It punishes the exact profile the retirement system spent 40 years telling people to become. Defer aggressively, work a full career, claim your benefit, and the code stacks a second tax on the first at the precise moment you can least maneuver. The saver deferred to escape a rate. The deferral built the balance. The balance forced the withdrawal. The withdrawal tripped the torpedo. Each step was the responsible one. Meanwhile, a household with more money is watching none of this happen to them. Two households, same $200,000 of economic gain in a single year. Watch what the tax code does to each, because the difference is not a matter of degree, it is a matter of kind. The first household is the software project manager and her spouse. Two W-2 earners, salaries and a bonus. The whole $200,000 arriving as labor. The second household holds a portfolio and lives off it. Its $200,000 arrives as long-term capital gains and qualified dividends. Neither household is hiding anything. Neither is cheating. Both report every dollar. And the federal treatment of those two identical-sized gains diverges so sharply that they barely look like the same tax system. Run the labor household first. Their $200,000 in wages faces the ordinary brackets, stacking up through 10, 12, 22, and into the 24% floor. On top of that sits the payroll layer, 6.2% for Social Security to the wage base, 1.45% for Medicare with no ceiling, carved out at the source before they see a dollar. Add a typical state income tax. Their blended effective rate on that real economic gain lands somewhere in the mid-20s. Every component attaches to the same trait. The income is labor, and labor is taxed at ordinary rates with the payroll surcharge welded on. Now the portfolio household. Their $200,000 is long-term capital gains and qualified dividends, and the code treats that as a different kind of dollar entirely. It rides a separate, gentler schedule, 0%, 15%, or 20% at the federal level. For a married couple in 2025, a substantial slice of long-term gains is taxed at 15%, and the first tens of thousands can fall in the 0% band before the 15% rate even begins. And the payroll tax, the 7.65% that hits every dollar of the saver's wages from the first cent, does not touch capital gains at all, not reduced. Absent. Here is the central truth the comparison exposes. The two households did not earn different amounts. They earned the same amount, wearing different clothes. The tax code does not primarily ask how much you gained. It asks what character your gain carries, labor or capital, and it prices those two characters on separate schedules that never meet. $1 of wages and $1 of long-term gain are economically identical to the person spending them. To the code, they are two different species. Unfold that, and the gap widens past the headline rate. Qualified dividends earn the preferential rate only if the underlying holding period is met, a rule the portfolio household satisfies simply by not churning. Their gains, once realized, face no payroll levy, so the comparison is not 24% against 15%. It is roughly 24% plus 7.65% plus state against 15% and nothing else. The saver's every raise is character locked as labor the instant it is earned. The portfolio household's income was born, by construction, on the capital side of the ledger. And this is where the loop opens. Character explains why the portfolio dollar is taxed less when it is taxed. It does not yet explain the more startling advantage, where that dollar can go, that the saver's dollar simply cannot. The labor household has one move available: earn, recognize, pay, in the same year, every year. The portfolio household has a second dimension the saver never touches. They can decide not to realize the gain at all. Let it sit, untaxed, for a year, a decade, a lifetime. The character of their income is favorable. The timing of it is theirs to command. The saver pays at the source, on the system's schedule, at the ordinary rate. The portfolio household pays a lower rate, and only in the moment they choose to trigger it. Those are two separate advantages, and this block has answered only the first. Character is half the story. The half that follows is stranger, because it turns on a question the saver's paycheck can never ask: when does the tax event happen at all? Think of the tax code as a toll bridge with two lanes. The saver's lane has no gate she can operate. A scanner reads her plate the instant she enters and bills her before she reaches the other side. The wealthy household's lane has a gate, and their hand is on it. They cross when the toll is lowest, or they idle at the entrance for years, engine off, paying nothing, watching the price of crossing drift in their favor. Same bridge, same destination. One driver is billed on entry, the other is billed on exit. at a moment of their choosing, if they ever exit at all. That is not a metaphor stretched for effect. It is the literal mechanism of realization, and it is the answer to where the wealthy household's dollar can go that the savers cannot. Follow it precisely. When a share bought at $40 climbs to $140, the $100 of gain is real wealth the moment it exists, but it generates no tax event. There is no return line for appreciation. The tax event is triggered only by an act, the sale. Until that act, the gain compounds on its full, untaxed balance, and the owner decides, unilaterally, when the meter starts. This is the timing lever, and it has 3 settings the saver's paycheck does not offer. First, the low year setting. A household that controls realization can sell in a year. Its other income is thin: early retirement, a sabbatical, a business loss, and drop the gain into the 0% or 15% capital band deliberately. The saver cannot decide her salary arrives in a low year, it arrives in the year she worked. Second, the offset setting. Realized losses elsewhere in the portfolio can be harvested and netted against gains, so the taxable figure is not the gross gain, but whatever remains after the household engineers the subtraction. Wages admit no such netting. There is no losing paycheck to cancel a winning one. Third, the spread setting. A large position can be sold in slices across many years, keeping each year's realized gain beneath the thresholds where higher rates and surcharges begin. The saver's income cannot be sliced. It is recognized in full, in the year earned, because no other year is available to it. The wealthy household's edge in this block is not a lower rate. That was the last chapter. It is control over the calendar. The saver is a taxpayer by default. The tax happens to her on payday. The holder is a taxpayer by appointment. The tax happens when he schedules it. And an appointment that can be postponed indefinitely is worth far more than a discount, because postponement lets the untaxed balance keep compounding, as though the government's future claim were an interest-free loan the holder gets to invest. Consider what that means over decades. $2 of identical economic gain. The saver's is taxed the instant it is recognized and can never be unrecognized. The holder sits unrecognized, growing, its tax bill deferred not by a plan administrator on the system schedule, the way her 401k is deferred, toward a mandatory withdrawal, but by the owner himself, toward a date he selects. Her deferral ends in a forced distribution at 73. His deferral has no forced end at all. And that is the door this block cracks open without walking through. If realization is a choice, then the most valuable choice is the one never made. A gain that is never realized is a gain the timing lever holds at 0, forever, for the life of its owner. The saver's dollar must eventually pass through the gate. The holder's dollar may be steered so that it never does. And the largest gains of all may never be taxed while their owner is alive. A gain that is never realized during a person's lifetime may never be taxed as income at all, not deferred, not discounted, erased for the heirs who inherit it. This is the last setting on the timing lever, and it is the one the saver's paycheck can never reach. Follow the mechanism to its end. A holder buys a position at $40. It climbs to $340 over 3 decades. That $300 of appreciation has generated no tax event because it was never sold. Realization never happened, so the meter never started. Now the holder dies, still holding. Under the step-up in basis rule, the cost basis of that asset resets to its fair market value on the date of death. The $300 of gain accumulated across an entire lifetime does not pass to the heirs as a tax liability. It vanishes. The heirs inherit the asset at $340, and if they sell it the next morning, their taxable gain is 0. Read that against the saver's life. Every dollar of her labor was taxed the year she earned it. Every dollar in her pre-tax 401k will be taxed as ordinary income when RMDs force it out, dragging the benefit torpedo along with it. Her heirs inherit a pre-tax account that arrives preloaded with the full ordinary tax still owed, an inherited IRA that must be emptied and taxed within 10 years under current rules. The holder's heirs inherit a clean stepped-up asset with the lifetime gain forgiven. 2 families, 2 inheritances. One carries a tax bill that was never paid. The other carries a tax bill that was paid and paid and paid again. Here is the historical parallel that makes the design legible. The step-up in basis is not a modern loophole slipped in quietly. It has been a feature of the federal code since the income tax was built out in the early 20th century, and it survived every major reform since. Congress twice tried to weaken it. The 1976 Tax Reform Act attempted to replace step-up with carryover basis, and the effort was so unworkable it was repealed before it fully took effect. The rule proved nearly immovable. Contrast that with the treatment of labor, which moved the other way across the same century. Payroll taxes were introduced in 1935, expanded repeatedly, and the Social Security benefit itself was made partially taxable in 1983 and again in 1993. Thresholds never indexed, as this video has shown. One channel was hardened in the taxpayer's favor and defended for 100 years. The other was steadily opened wider to collection. The saver stands in the channel that history taxed more heavily over time. The holder stands in the one history left almost untouched. Sit with what that arrangement actually rewards. It does not reward effort. The saver supplied that in abundance. It does not reward virtue, or planning, or restraint. It rewards a single posture, holding an appreciating asset and doing nothing. The most tax-favored act in the entire code is inaction extended across a lifetime. The saver's whole identity was built on the opposite instinct: contribute, escalate, optimize, act. She was rewarded for motion by her employer and by every article she read, and taxed for motion by the code underneath them both. None of this is an argument that she erred. It is an argument that the endgame of the two channels was never symmetrical. Her diligence terminates in a taxed distribution and a taxed inheritance. The holder's stillness terminates in a forgiven gain. Same country, same law. Opposite exits. Which leaves one honest thing left to do. Stop describing the two households in words and put them on a single page. Same real gain, side by side, every tax counted, and read the two effective rates aloud. Put both households on one page. Same real economic gain in a single year, $200,000. Every tax counted, nothing hidden, nothing exaggerated. Read the two effective rates aloud, because until now this video has argued in mechanisms. This is the arithmetic that ends the argument. Start with the saver's household. Two earners, $200,000, arriving entirely as labor. Walk it in order. The ordinary brackets stack up through 10, 12, 22, and into 24%. And after the standard deduction, the federal income tax lands somewhere near $28,000. That alone is an effective federal income rate around 14%. But labor never stops there. Layer the payroll tax. 6.2% for Social Security to the wage base, and 1.45% for Medicare with no ceiling. Roughly $13,000 more, carved out at the source, on the first dollar and every dollar. Add a mid-single-digit state income tax, call it $9,000. Total taxes on their $200,000 of gain, close to $50,000. Blended effective rate on real economic gain, roughly 25%. Now the same $200,000 for the portfolio household, arriving as long-term capital gains and qualified dividends. The turning point is not a lower bracket. It is that the gain enters on a different schedule entirely. For a married couple in 2025, a slice of long-term gains falls in the 0% band, and the remainder is taxed at 15% until income climbs high enough to reach 20%. Take the conservative case, nearly all of it taxed at 15%. Federal tax on the same $200,000, roughly $28,000, coincidentally near the saver's federal figure, but assembled without a single payroll dollar. Because here is the consequence that reorders everything. The 7.65% payroll levy that took $13,000 from the saver takes exactly zero from the portfolio household. Capital gains are not labor. The payroll machine never touches them. Depending on the state, that state tax softens too, since several states tax the two characters differently, and the household can steer realizations toward a low tax year. Read the two numbers side by side, same $200,000 of real gain. The saver's household hands over close to $50,000, an effective rate near 25%. The portfolio household hands over roughly $28,000, an effective rate near 14%. Same country, same year, same size of gain. Nearly double the effective burden on the household that earned its money by working. And this is the honest, uncomfortable answer to the question this video opened with. The saver was told her 24% bracket was the ceiling of her burden. It was closer to the floor. The wealthy household's 15% headline rate was closer to its ceiling. The bracket table pointed both of them in exactly the wrong direction. When you measure the only honest thing, every tax paid, divided by every real dollar of economic gain, the disciplined worker on $200,000 of labor pays a materially higher share than the household living on $200,000 of capital. Not because she earns more, she earns the same. She pays more because of what her income is and when it is taxed, and that she never gets to decide either one. Widen it and the gap grows, not shrinks. Push the portfolio household's realization into a low-income year and its rate drifts towards zero. Let the gain go unrealized, and the rate is zero this year by definition. The saver has no such dial. Her $200,000 is recognized in full, in the year worked, taxed at the source, payroll included, with the pre-tax 401k merely rescheduling part of it toward a taxed and torpedoed withdrawal later. The comparison is not close, and it does not favor the person who did everything the culture called responsible. Which returns the whole video to the one thing arithmetic cannot explain. She could see the pay stub, she could feel the bite. The numbers on this page were, in principle, always available to her. So why did the saver keep pouring dollars into the worst channel willingly? Why would a numerate, careful person keep feeding the worst channel long after the pay stub gave the game away? The answer is not in the tax code. It is in a study about how people come to love the things they worked hard for. In the late 1950s, two social psychologists ran an experiment that has been replicated in various forms ever since. Volunteers were asked to complete a tedious, pointless task to gain entry to a group. Some were let in easily. Others had to endure an embarrassing, effortful initiation first. Then, everyone rated how much they valued the group they had joined. The same dull group for all of them. The result was clean and counterintuitive. The people who had suffered to get in rated the group as more worthwhile, more interesting, more worth belonging to, not despite the effort. Because of it. The mind resolves the discomfort of hard work by upgrading its opinion of what the work bought. Psychologists call it effort justification, a specific case of reducing cognitive dissonance. The finding has held across decades of follow-up research. The harder the entry cost, the more the reward is prized, whether or not the reward improved. Now set the disciplined saver inside that finding. Her financial life is built almost entirely out of effortful, visible acts. She dragged the contribution slider to the annual maximum. She enabled auto-escalation. She updates a spreadsheet on the first of every month. She resisted the new car, the bigger house, the impulse she could have afforded. Every one of those moves cost her something she could feel: a smaller paycheck, a foregone pleasure, a Tuesday afternoon spent optimizing instead of living. And the mind does with financial discipline exactly what it did with the pointless initiation. It converts the felt cost into felt value. The very difficulty of maxing the 401k becomes proof, at the level of feeling, that maxing the 401k must be the optimal act. That is the trap, and it is not a trap of ignorance, it is a trap of labeling. The behaviors that are hardest to perform, deferring, restraining, contributing more than is comfortable, get labeled in the mind as the behaviors that matter most. The channel the money flows through is invisible and effortless to change. It requires no willpower at all, only information, so it never gets the credit or the scrutiny. The saver measures her financial virtue by the size of the sacrifice, not by the effective rate on the dollar. She over-indexes on the visible discipline and underweights the silent structure because the discipline hurt and the structure did not. This is why the pay stub could sit in front of her month after month and change nothing. The number was available, the frame was not. She was not looking for a channel problem because everything her mind rewarded pointed at effort, and her effort was beyond reproach. A person cannot solve a problem she has been conditioned to experience as a virtue. So the reframe that ends the guilt begins here. The saver's discipline was never the flaw. It is a genuine asset, the rarest and hardest part of the whole equation, the part most people never manage. The flaw was aiming that discipline at the one lever that responds to sacrifice, while the levers that actually move her effective rate, character, timing, realization, respond only to knowledge and ask nothing of her willpower at all. Which raises the question that the final stretch of this video exists to answer. If the fix is not more discipline and not less saving, then what exactly does a W-2 earner change without first becoming wealthy? Because the levers described so far, realization control, the step-up, character-shifted income, have looked, until now, like they belong to people who already hold the capital. The fix is not to save less, it is to change what the saving becomes. The levers described so far, realization control, character-shifted income, the forgiven gain at death, have looked like equipment reserved for people who already hold capital. That impression is the last thing standing between the saver and her fix, and it is wrong. Not entirely wrong, wrong in the way that matters. Because the wealthy household's three advantages are not identities, they are settings: character, timing, realization. And a W-2 earner, still earning every dollar through labor, still maxing nothing she was told to max, can move each of those settings a measurable distance without a single new zero in her net worth. She does not become the portfolio household. She borrows the portfolio household's dials, one at a time, inside the life she already has. Take character first. The saver's problem was that every dollar arrived and stayed labeled as labor. She cannot relabel her salary, but she can decide what her savings become the moment they leave the paycheck. A dollar routed into a taxable brokerage account and held in a broad, low-turnover index fund stops being labor the instant it lands. Its future growth is capital, taxed on the gentler schedule, with no payroll levy on the gain and full control over when it is recognized. Same dollar she would have deferred, different species on the other side. Now timing. Consider the same software project manager, unchanged salary, unchanged habits. Suppose she splits her retirement saving instead of pouring all of it pre-tax. Part still goes to the 401k to capture the employer match. That match is free money and never in dispute, but a meaningful slice now flows to a Roth account, where tax is paid today at a rate she can see, and every future dollar of growth and withdrawal comes out untaxed, invisible to combined income, and therefore incapable of tripping the Social Security torpedo later. And another slice goes to that taxable brokerage, the account that, unlike the 401k, lets her choose the year she realizes a gain, harvest a loss against it, or simply never sell. She has not saved a dollar less. She has spread her future self across 3 channels with 3 different tax characters, so that at 73 she can choose which spigot to open instead of being forced to open the one the code taxes hardest. That is the whole intervention, and notice what it asks of her. Nothing her willpower recognizes as sacrifice. The discipline was already there, the rarest ingredient, the one most people never assemble. What changes is not the amount and not the effort. What changes is the destination. She keeps the automatic contribution, keeps the escalation, keeps the spreadsheet, keeps the restraint. She redirects the flow. And the realization lever, the one that looked most out of reach, turns out to be the most democratic of the 3. Every taxable account holder at any net worth owns it, the right to hold. The right to sell in a thin income year, a sabbatical, a gap between jobs, early retirement before Social Security and RMDs begin. The right to let an appreciated position pass to heirs on a stepped-up basis. None of that requires being rich. It requires owning the asset in a channel that permits the choice, rather than one that forecloses it. The loop closes here, plainly. A W-2 saver can change the channel without becoming wealthy first, because the channels were never gated by wealth. They were gated by knowledge, and by a lifetime of being pointed at the one lever that responds to sacrifice, while the levers that move the effective rate sat unlabeled, asking only to be understood. She keeps her discipline, she changes its destination. The bite gets lighter, not because she earns differently, but because her dollars finally arrive wearing the right clothes. Which leaves the original question, the one this whole video was built around, no longer a grievance, but something she can actually answer. Return to that Tuesday afternoon, the 42-year-old software project manager, the max slider, the smaller than expected deposit. She had a suspicion she could not justify, that for all her discipline, the tax bite fell harder on her than on people with far more. She was told that feeling was envy, or ignorance, or a loophole she had failed to find. It was none of those. It was arithmetic. And now she can read the arithmetic in her own hands. Play the two lives forward. In one, she does exactly what the culture applauded. Everything pre-tax, everything deferred, discipline poured entirely into the channel, taxed at the source, taxed on the system schedule, taxed as labor to the end, and at 73, taxed again through the torpedo she never saw coming. Roughly a quarter of every real dollar of gain, gone, on a household earning the same as one that pays 14%. She did nothing wrong, and the code treated her as though she had. In the other life, she changes nothing about her effort. Same salary, same restraint. Same spreadsheet on the first of every month. She simply lets a portion of her savings arrive wearing different clothes. Some Roth, some taxable brokerage, the match still captured, the discipline fully intact. At 67, she is not staring at one forced spigot. She is holding three, and she gets to decide which one opens, and when, and how much of her Social Security stays hers. That is the entire difference between the two lives, not the amount saved, not the willpower spent, the destination of the dollar. Here then is the honest answer to the question this video opened with, standing unanswered for 40 minutes. If the saver did everything right, why does the tax code treat her worse than someone who did nothing but hold? Because the two things the code rewards most, favorable character and controlled timing, are not things you earn through effort. They are things you elect through structure. The wealthy household did not outwork her. In most cases, it did not outdiscipline her. It simply held its wealth in channels where the gain is capital instead of labor, recognized on command instead of at the source, and, at the very end, forgiven rather than collected. The saver aimed her formidable discipline at the one lever that responds to sacrifice, how much she deferred, while the levers that actually move an effective rate sat unlabeled beside it, asking not for willpower, but for understanding. That is why the pay stub could sit in front of her for years and change nothing. Her mind had been trained to measure financial virtue by the size of the sacrifice, and her sacrifice was beyond reproach. The problem was never that she saved too little. It was that no one told her a saved dollar has a character, and a timing, and an exit, and that all three were negotiable. So the reframe is not a rebuke. It is a promotion. The discipline she built is the rarest and hardest part of the whole equation, the part most people never assemble at all. Nothing here asks her to surrender it. It asks her to point it somewhere the code cannot punish so precisely. Keep the automatic contribution. Keep the escalation. Keep the restraint that resisted the bigger house. Then redirect the flow, so the future self who did all that work does not arrive at 73 holding a single spigot the government designed to tax hardest. The tax code did not treat her worse because she failed. It treated her worse because she succeeded through the one channel it was built to tax most heavily, and because the channels that escape it were never gated by wealth. They were gated by knowledge. That gate, unlike a net worth, opens the moment you understand it is there. She keeps her discipline, she changes its destination, and the question that felt like a grievance becomes something she can finally act on. This is education, not personalized advice. Wealth is built to last, but only when it flows through channels chosen on purpose.